Namaste candidates. This video covers the FRM Part II 2026 curriculum changes based strictly on the official GARP learning objectives. So we'll compare the 2025 and 2026 curriculum to identify what is new, what is removed, what has moved from other modules, and what remains unchanged. So let's start. Here is the high-level snapshot of how FRM Part II evolves from 2025 to 2026. Total readings increased slightly from 104 to 107, and exam weights remain unchanged. The largest changes are concentrated in investment management, which expands from 11 to 17 readings, and of course, current issues, which undergoes its usual annual refresh with substantial topic rotation. The next layer of change sits in liquidity and treasury risk management. This section is streamlined a little through the removal of one reading, relocation of another reading, and a small learning objective deletion. Finally, market risk and credit risk see only minor learning objective wording changes, and operational risk completely remains unchanged. An important point is that the exam weightage remains exactly the same for 2026. Market risk, credit risk, and operational risk. Okay, all these three modules continue to carry 20% weight each. LTR, liquidity and treasury risk management, and IM, investment management, they both remain at 15% each, and current issues stays at 10%. So there is no change at all in how the weights are distributed across the subjects. What has changed is the content within certain modules. So let's start by looking at the reading level changes first. Okay, this chart shows where the curriculum changes in size, module by module or subject by subject, you can say. So market risk, credit risk, and operational risk, as I said, essentially they stay flat. Liquidity and treasury risk, it reduces from 19 to 17 readings. Investment management expands from 11 to 17 readings, which is, as I said, the largest shift in Part 2 this year. Current issues moves from 9 to 8 readings, but that smaller count still reflects major topic rotation. Let's see why investment management is the single biggest change in FRM Part 2 for 2026. In 2025, investment management had 11 readings. In 2026, this increases to 17 readings. So that is a net increase of 6 readings, which translates to almost a 55% expansion, all within the same exam weight, right? That has not changed. Now, if you break this down, 8 readings are retained from 2025, 3 are actually removed from the investment management module, and 9 readings are added, out of which 7 are completely new and 2 are moved in from other modules. Okay, so this is not just incremental tweaking. This is a structural rebuild of this investment management module. The next question is, what exactly has been added to investment management? See, this expansion is not random. It follows a very clear theme. First, there is deeper coverage of hedge funds, not just strategies, but also how they are governed and regulated. Second, there is a strong emphasis on private markets, including private equity, private debt, and private capital allocation decisions. And third, there is increased focus on risk monitoring and due diligence, especially at the manager and fund level. Okay. Then also we have scenario analysis and stress testing, which are now explicitly a part of the investment management framework, and it is not treated as a separate risk exercise. Okay, so they are individual chapters, actually individual readings. And finally, there's a dedicated attention to liquidity and asset illiquidity as well, reflecting the reality of managing less liquid portfolios. So the expansion in IM is not just about adding volume. Okay, it is about shifting the section towards applied real world investment risk management. Okay, now what has been taken out of IM? First, the reading on risk monitoring and performance measurement is removed. from the investment management module. This topic does not disappear entirely, but it is no longer treated as a standalone academic chapter. Okay, so there are bits and pieces here and there already covered. Second, the older academic hedge funds reading, okay, that is now removed. The coverage of hedge funds in 2026 has been redesigned and slightly repositioned, you can say, okay, rather than simply being retained. And third, the earlier Madoff case study, which was titled Finding Bernie Madoff, that is removed. And this is replaced with a different reading that focuses more explicitly on fraud warning signs and red flags. So the message here is quite clear. Investment management is not just expanding, it is also rebalanced by removing older or purely academic material and replacing it with more applied, or you can say practitioner related content. Now let us look at what has been moved into investment management from other modules. Now, two important readings are transferred in 2026. The first one is private credit, which moves from current issues into IM, investment management. As you all know that there are other readings on private credit as well, which have come into investment management. So this reflects the fact that private credit is no longer treated as a short-term market theme. It is now examined as a core investment exposure. And the second reading is illiquid assets, which moves from liquidity and treasury risk, LTR, into this IM. So this aligns illiquidity with portfolio construction, asset allocation, and exit risk, rather than treating it as a purely a funding issue. Okay, so these transfers are not cosmetic. They show a clear repositioning of where GARP wants candidates to think about private credit and illiquidity. Okay, now one interesting point is that this chapter, illiquid assets, was actually a part of investment management only before 2020. So in 2020, the liquidity and treasury risk management module was introduced by GARP in the FRM Part II curriculum. Before that, it was not there. Only 5 modules were there. So under that regime, this particular reading, illiquid assets, was, if I remember correctly, the 4th chapter of investment management. So now it's back to investment management only. Let us now move to current issues in financial markets. This module is designed to change regularly every year, as you all know, and 2026 follows that pattern. In 2025, current issues had 9 readings. 9 readings, yes. In 2026, this reduces slightly to 8 readings. But this smaller number does not mean fewer changes. Okay, if we break it down, 3 readings are actually retained from 2025. 6 readings, they leave the current issues list, out of which one is not deleted but actually moved to investment management, as we just discussed. And 5 entirely new readings are added. So what we say here is a large rotation of topics every year, right? Even though the net count changes only marginally. Out of the 9 readings in current issues for 2025, only 3 are retained for this year. These readings continue to focus on macro financial stability and system level resilience. The first retained reading is the BIS Annual Economic Report section on monetary and fiscal policy, which remains relevant for understanding policy driven stability risks. The second is the IMF reading on regulating the crypto ecosystem, reflecting the continued importance of crypto related financial stability issues. And the third one, the third retained reading, it actually focuses on digital resilience and financial stability, addressing operational and cyber resilience in the financial system. So all 3 readings are renumbered, but their content continues into this 2026 syllabus. Now let us check the readings that leave the current issue section for 2026. First, the readings related to 2023 bank failures and resolution lessons, it has been removed. So these were event specific and they were tied to a particular crisis period, right? Next, the earlier set of readings on artificial intelligence, which focus largely on risk considerations and central banking perspectives, it has been removed. Then the reading on interest rate management by emerging market banks, that reading has been removed. Then this BIS reading on laying a robust macro financial foundation for the future is also removed. And finally, the reading on the rise and risks of private credit, it leaves the current issues section. So this one is important because it is not deleted, it is moved into investment management, as we have discussed twice, okay, today, where it is treated as the core investment risk topic, okay. Okay, now additions. 5 new readings have been added to current issues this year. So 2 of these, they focus on AI, but from different angles. One examines AI application in capital market activities. The other looks at the financial stability implications of AI at a system level. There is also a new BIS reading on the global drivers of private credit, okay, which looks at the growth of private credit from a macro and system perspective. There's also a new reading on geopolitical risk, okay, linking geopolitical shocks to market and financial stability outcomes. And finally, a new reading on tokenization and financial market inefficiencies examines how tokenization can affect market structure, pricing, as well as liquidity. So together, these additions, they shift the current issues toward forward-looking, technology-driven and system-level risk themes. Okay, so overall, just like every year, current issues moves away from event-driven and backward-looking material towards, of course, a refreshed set of forward-looking themes. Let us now look at liquidity and treasury risk, LTR. This section is streamlined a little for 2026. The number of readings reduces from 19 to 17. This happens through two structural changes, not a broad rewrite. Okay, the first change is that the reading managing and pricing deposit services is completely removed from the Part 2 curriculum. Second, the reading illiquid assets, as I said, is again moved out of liquidity back to investment management, okay, where it is now treated as a core part of the investment decision framework. Now, in addition to these two chapter level or reading level changes, there is also one learning objective deletion in LTR 5. This learning objective is removed to differentiate between factors that affect the choice among alternative sources of reserves. Okay, all the other learning objectives in LTR 5 remain unchanged. So liquidity and treasury risk LTR is not at all overhauled, it is just sharpened a little. Okay, just a little clearer focus you can see on core liquidity and funding concepts. Now, both market risk and credit risk modules, they remain structurally stable for 2026. The number of readings does not change, and there are no additions, no removals or relocations. In market risk, there is only one learning objective wording refinement, you can say, in the first chapter, estimating market risk measures. That learning objective change, it clarifies how VAR is framed, shifting the wording from return distributions to asset price distributions. And in CR, there is also one learning objective refinement. The learning objective in the reading on CR9, estimating default probabilities, it now places a clearer emphasis on applying the Altman Z-score methodology for predicting firm default. So these are just precision edits, not content expansions. They do not change what you study, but they do affect how concepts are described and tested in the exam. Operational risk and resilience is the only Part 2 module with absolutely no changes for 2026. This module continues to have 24 readings, exactly the same as in 2025. Okay, so there are no additions, no removals, no relocations, and no learning objective changes. Every learning objective remains identical from 2025. Okay, so from a preparation point of view, especially for repeat candidates, this makes ORR one of the most stable sections of Part 2, right, this year. So repeating candidates, they can comfortably treat operational risk along with, of course, market risk as well as credit risk as stable anchors, and they can focus additional effort on the sections that actually changed. Now, this table brings together all FRM Part II curriculum changes from 2025 to 2026 in one place. So it compares the two syllabi reading by reading, and it clearly shows what was added, what was removed, what was moved, what was renumbered or slightly edited across all modules. Now, there is no interpretation here. This is simply a direct structural comparison of the GARP syllabus for these 2 years. Okay. So if you want this for your own reference, you can just download the Excel version of the table along with a PDF summary of all curriculum changes from our website. You can also WhatsApp us directly on our number, and we will share both the Excel file as well as the PDF with you. Okay. So this table is just meant to be a single reference point for understanding exactly what changed in FRM Part II for 2026. Okay, so with that, we come to the end of this overview video. If you need any help or clarity, you can simply WhatsApp us with your questions. We are happy to support you, whether or not you choose to enroll with us. Okay. Namaste and all the best for your FRM preparation.